Hey everyone, it is Friday and we are closing out the week strong with our expert series. We always close out with Jonathon Twomley. How you doing, sir?
I'm great, Michael. How are you?
I'm doing very well. So the last month, maybe 6 weeks or so, we've always started our discussion with the new unemployment claims. So I'm sure you saw them yesterday. Any kind of first blush of what's going on?
Yeah, well, we seem to be, the unemployment claims are back up over 1 million first-time claims, right?
Yep, 1.1.
That means that the last 3-4 weeks, we've sort of been bouncing around. The trend to lower and lower claims every week has stopped, or at least it's stalled out. And that suggests that we're at some kind of plateau or temporary bottom of the unemployment claims. And I think probably it's reflecting, I haven't dug into the data to see where the claims are up, but I'm imagining that, we've got several states, particularly in the South, that are really having a lot of flare-ups. They're having to shut down again. And I think that's probably where it's coming from. And school starting, we've already seen, several major universities have, after, an entire week of classes, they've all gone online. So you've got UNC, you've got Notre Dame, you've got, I'm sure there are others out there that have gone, that have had to go back online. And I think this is really what you're going to see once school goes back. I'm personally, basically at this point, I'm just, we're sending our kids for the part-time option when school starts, but we're assuming that, after a week or two, there's going to be COVID cases and they're going to shut everything down and it's going to be full-time online again. So that's unfortunately, I think, going to lead to more unemployment in the fall. And with, Congress just took off without passing a bill. And, although President Trump has said he's handing out money, it's constitutionally unclear whether he actually is able to do that. And it also depends on state participation, and only like 4 states have signed on to this.
Now 11 as of this morning. And I think North Dakota or somebody said go pound sand, or Wyoming or somewhere said no, thank you.
Because it's also they've said, the states have to add money to this, which is also, this gets into like obscure points of constitutional law, but the federal government cannot force the states to spend money. The federal government can say, hey, we'll match money for you. They can induce them to spend it. They can say, here, we're going to give you the money. This is how you have to spend it. Or they can say, if you spend this money, we will spend this additional money. But the states cannot be compelled to do anything by the federal government. So I haven't sort of dug enough into this executive order to see whether it's, I guess it must be voluntary because states have to choose to participate, because they can't force them to. But so that also, imposes some limits. I think frankly, in New York too, I think Governor Cuomo said, like, no way, we're not spending, we don't have that $100 per person to spend.
New York and California, both our governors said, you're smoking crack. We don't have the money. I don't know what you're talking about. Right. Sorry.
So the states can't print money. So unlike the Fed, the federal government, so they're stuck with, with what they've got. And tax collections are down for the states, and they're going to have to be furloughing workers pretty soon if they haven't already as well, which is going to not help with the unemployment.
I think when I looked at the numbers yesterday, what I really saw was, there was definitely probably a bias towards the South, right, with their COVID cases kind of having more unemployment. But my great fear, and we'll know next week, it'll be validated next week, is the PPP money ran out. Right. And, if you took a PPP loan and you could get it, forgiven by covering 75% with employees, well, that time frame's over. And as you just said, Congress left without replenishing it. What are you going to do? You're going to hope Congress gets off their butt and retroactive does it? I don't think I wouldn't count on them for a second to do that. So they're laying people off. It's what the math says, right?
Yeah, and that will be reflected in the numbers, and we're still a long way to go on this COVID thing. And I it's funny. I was talking with some friends, and they were saying, wouldn't the right thing to have done, or you could still do it, frankly, is if you say, we're just shutting down everything for 3 weeks, right? Just nobody leave their home for 3 weeks.
Mm-hmm.
You, if the disease actually is what they say it is, and it's got a 2-week incubation period, then in theory, you could just like wipe the whole thing out in 3 weeks. But I don't think that we have the will to do something like that. I mean, there's been, so I think we're just going to be dragging on.
Everything's
with this thing
political these days. Yeah.
I think we're just going to be dragging on with this thing until we finally develop herd immunity. And that seems to be very far off, because I mean, the numbers required for herd immunity are way higher than we are right now in terms of past infections. So
my analogy of a bridge, I think, is still playing out. We built a bridge halfway over this chasm, which you can call a recession or would have been a depression, but Congress failed to build the other half of the bridge, and we're going to suffer. I think by sometime next year, we have higher herd concentration, whatever you want to call it. We have some kind of vaccine, which only part of the population will take. And then we have better treatments. So hopefully we've taken death off the table.
Right.
But we've got 6 more months of this. It's going to be rough, I think.
Yeah. And with everybody going back indoors. That's going to make it, I guess we've got a few more. If the weather stays warm, in the north, then maybe we can.
Oh, it's weeks though. It's 8 weeks. It's 10 weeks. It's not month. I mean, you could say months, but it's 2 months. It's a month and a half.
Yeah, it's true. I mean, now they're talking, like, for instance, in New York City, they're talking about, or actually those heat lamps, those outdoor heat lamps. Mm-hmm. You can't buy one now because they've all been,
of course,
sold out, because everyone is buying them up for outdoor restaurants.
They want that extra week. They want to get one more week of outdoor dining.
They can get a couple. But the thing is, like, if you think about it, like, they can't really construct, a lot of outdoor dining places, you'll see they're sort of wrapped in plastic, right? They've got that vinyl stuff, but you can't do that because then you're indoors, right? So they've got to turn these heat lamps on, and hopefully there'll be enough that maybe you can get into sort of like November or so under the heat lamps. But then once that happens, I mean, then the restaurants are all back to trying to survive on deliveries until like March, right? And I don't know how. Honestly, I don't know how they're going to do it.
It's not. I mean, no, it's not. They're just not. I mean, you can't. We're going to have more. Yeah. Again, we built a bridge halfway, and now we're paying the price. And this Congress went home is just not cool.
Yeah. I mean, and listen, I mean, I think that there is some evidence out there. I mean, I've seen anecdotal cases of this, but there still doesn't seem to be any kind of large scale information that the mask wearing really does make a difference. And, maybe like if both people are wearing masks, like I've seen cases of, barbershops where the barbers were nobody knew this, but the barbers were COVID positive, and then nobody got infected because they were wearing masks, and their customers were wearing masks, and everybody was okay. So if that's the case, maybe we might be able to get, if we had enough mask compliance, that we'd have, we could get to a point where we could start going about something like normal lives again, if everybody would just wear, the mask. But, we've got a lot of resistance to that, for various reasons. Some of it just people who just don't like being told what to do, no matter what it is, but, at some point, I think we're going to have to start making some serious sacrifices if we want to get through this thing.
Yes. We will eventually get through this thing. The question is the length, the depth, and the pain that we are going to suffer.
Yeah. And it's definitely more than we would have suffered if we had just bit the bullet up front.
Oh, no question. Yeah. There's no question. Well, all right. Let's get off that happy topic. Yeah. Let's talk about one thing that you and I started talking about, right? We're landlords and multifamily folks, but we started talking about flipping being hot for 6 to 18 months. And I don't know if you saw it, but man, let me read some of the numbers. Existing home sales came out this morning. For July, existing home sales, and these are national numbers, so I didn't get the breakdowns. Sales are up 24.7%, strongest ever. Highest since December 2006. Inventory down 21.1%. Months went from 4.2 to 3.1. The median price broke 300 for the country at 304, and price increase was 8.5% year on year. Even if you had inflation adjusted, we are still 3.4% above the 2006 peak of value. And the final number is days on market has dwindled to 22. Wow.
Yeah, those are some impressive numbers. I mean, and it certainly reflects what I've been seeing in my own personal journey to buy a house, right? Where I'm in contract on a house way upstate. As
4 hours, right? 4 or 5 hours, something like that.
Yeah, it's about 4.5 hours from New York City, which is fine.
That's a haul.
It's a haul, but it's we've done that trip so many times. It's we got it down to a science.
But it's a long weekend haul, right? It's not an overnight.
Not really, it's not a exactly. It's not a like go up Friday night, come back Sunday kind of thing. It's more of a we're going up for a week or two kind of thing, right? Or a long weekend. But the thing that I've seen, and this we're looking in areas of New York State where the population is really flatlining. There's not a lot of inward migration up there because these are small towns and rural areas where the population is aging. And, as it is actually in rural areas everywhere in the United States, even in the fastest growing states in the South, the rural areas are declining in population. It's the MSAs that are growing, the suburbs and the cities, but it's a phenomenon throughout the country that rural areas are becoming depopulated. And it's actually not just the US, it's throughout the world.
Sure.
You just don't need that many people to grow stuff. And people want to have, they want city and suburban life where they can meet people and there's more stuff to do. So young people tend to go to these other places, and you're just left with old people, and eventually they're dying off. So anyway, that being said, but even in an area that is far from New York City, far from the growth center of the state, which is New York City, there is very little inventory for new houses, not just for new houses, existing houses, and things are on market for a very short period of time, and they're being bought up, at asking or above, generally speaking. And it's an incredible phenomenon because, I had been watching this market for several years, and it was actually getting worse. I mean, right before COVID happened, the houses were just sitting on the market, price cut after price cut after price cut. And now you're seeing the opposite happen. And it's actually happening within New York City too. I think a lot of people there's been a lot of attention paid to the flight from the cities, right? And certainly there's some of that going on. But within the cities, people are also moving from apartments to trying to sell. Like if you have a house in New York City that has a yard, and there are lots of, people I think don't really realize this. There are lots of places in New York City where you can buy a house with a yard. And, it might be a brownstone, row house or something, but there's a lot of housing stock that has yards. And so if you have either an apartment or a house that has a yard, you have no problem selling that right now to people who just want
space is good.
Some space. Yeah. Because, and it's not even, I don't think, fear of like getting infected, it's just needing someplace to go. If you can't, if everything is shut down, you want to at least be able to just go outside someplace.
Well, I think it's more than that. I think it's, if you are stuck somewhere, let's just pick on a 2-bedroom, 1-bath apartment with 4 people in it, mom, dad, 2 kids. You can't work. Yeah. You can't work. You can't raise kids. You can't do all of these things inside an 800 square foot thing. I mean, you could for a day or two, right? Like if it's snowing, right? You have school shut. Yeah. You can make it work, but to do it for 5 months, that's a non-starter.
Yeah. I mean, I literally, if I did not have an office, I would not be able to get any work done because I cannot work at home with the kids there. I don't have my own space to work, and they take over everything. So that you can't make the kids stay in their room. They won't do it. Like, so they kind of wind up, one of them is in their bedroom. One of them is taking over the living room. My wife is in the kitchen and, there's not enough space in my bedroom for a desk. So I don't have anywhere to go. So,
Yeah.
so fortunately I have this office to come to. But yeah, if you're in that situation, and if I had a backyard, I could go out there and sit in the backyard
Yeah.
at like the picnic table with the Wi-Fi and do work
Exactly.
outside, or send the kids outside or whatever.
Yeah.
But
Go play outside, kid. Boom.
yeah, but you can't. So
That's what's
the outdoor
happening.
space is just really at a premium.
Yeah.
Yeah.
Space is good. And again, I think what we are seeing, again, back to these numbers and your experience in upstate New York, is I think a lot of people are making that decision, right? And there was always a question about, is this an investable trend or is it a short-term thing, right? And what I'm seeing, what I'm reading about, my experience is far more San Francisco and California, but I have a place, as you know, in New York, in Astoria, and so I talk to my daughter all the time, and there's moving trucks everywhere. And generally speaking, you don't want to move twice in a short period of time, right? It's not cheap, it's not fun. And if you're going to plunk down some significant money for a house and you're going to go from renting to owning, I think we're past a short-term blip. I think it's now an investable trend. And we're seeing numbers where it's a profitable investable trend, right? 8.5% increase year on year. I mean,
yeah. And I think, as we've talked about before, I think that there are a lot of people, certainly what I've seen upstate, is that the stuff that's really moving is, turnkey,
ready to go.
ready to go houses, or just stuff like what I'm buying, which really needs very little work. It needs a little, but it's not, it's just,
it's livable
wear and tear stuff.
Yeah.
It's totally livable. Whatever you want to upgrade, you can upgrade while you live there. That's the stuff that's sitting on the market, and where potentially there's some opportunity is the harder lifts, right? And where if you can buy something for a good price and renovate it, you should be able to sell it very fast once it's been renovated. Especially, I think, if you're in kind of a warm weather state where
you don't have the winter
tending
shutdown
to move.
You
don't have the winter shutdown and everything else. So I think that there's definitely opportunity here, and certainly I remain skeptical about whether this is a long-term trend, and that like, oh, nobody's going to live in a city anymore. I'm very skeptical about that. But I think for the next 18 to 24 months, I think there's going to be a lot of movement, and I think there's this opportunity. And I think psychologically, once people have made the decision to move, even if like COVID suddenly disappears, like if it just up and vanished tomorrow, I think there'd be a lot of people who would still move because they've already decided.
They're committed.
They've convinced themselves like, oh, wouldn't it be great to live in a house and have a yard and all that kind of stuff.
Swing set and blah, blah, blah.
That's right. And that's not going to change simply because the original reason why they want to move has disappeared. Like they've already psychologically committed. So I think this is going to last for at least a couple of years.
Yeah, I think you're absolutely right. And I think in those couple of years, I think two things are pretty certain. I think the suburbs will see an increase in value. And I think the populated areas will see a decrease in rent. I think both of those are, you could bet on both those things, I think.
Yeah. I also really, and I have nothing, I don't have any stats on this at all, but I do, if homes are selling at such a rapid pace, if you think about, well, who is able to move that quickly? Well, they're all renters, right? Because people who have a home that they need to sell can't move that quickly. And if they're trying to sell in a place that's currently out of disfavor, right, they're stuck, right? So they can't, unless they're going to take a huge haircut off of the place that they live in.
Which is happening. I don't know if you saw a couple of New York places took a 50% new premium condos, or whatever the hell they're called, high-end condos. Yeah.
Well, that's not, that was already a problem here in New York, where there was so much overbuilding. The only thing that's gotten built in the last 10 years has been super luxury. And a lot of that was already taking price cuts as, if, for instance, the Russian money was cut off and the Chinese money was cut off. So things were already, because all that stuff was built for those people, right? They weren't built for people who live here. But now, but then to the extent that other stuff was getting built, it was still high end. I mean, it was like $2 million apartments. It wasn't, so that doesn't even qualify as like super luxury in New York, right? So it's, but I think what's happened, what you're seeing, that stuff was starting to already sit on the market when people were thinking like, where's the economy going and, everything else. Then with COVID, I mean, I think you've got a lot of developers who are like way out over their skis and and for rentals too. I mean, I think that it's tough right now for people who, you know, are renters and they can work from anywhere and they don't have to be here right now. You know, they're like, hey, I'm going to go home. I'm going to go somewhere else, this other city I wanted to explore. And I think there's going to be a lot of pain for developers in New York. And that's why you see that stuff really, them slashing prices on things.
Yeah.
But I think for people who own their homes, like
Mm-hmm.
it's very different. It's harder for them to like sell at a loss or, you know, or even, you know how people are like this, like, oh, my house is worth this, right?
Right. It's very sticky.
You know,
Price elasticity is tough on the downside.
The professional developers will say, well, this is what the market is. And they won't necessarily hold out. They're just going to try to
they want to
cash.
survive. Yeah. They
want to get cash. But the homeowner is like, last year, my house, you know, the house next door sold for $2 million. So that's what I'm going to get for mine. And they've planned their entire existence around selling for $2 million. And if the price is now 1 million, like, it's very difficult for them to accept that. So,
yep. Renting to owning. I think you're right. I think that is I think there's two things that are investable. I think we're going to see an uptick in owner occupancy because renters are becoming owners, right? The millennials are now in their 30s, or right on the cusp, and they're owning. And you're right. I think it's out of the cities to the suburbs. Again, my crystal ball can't look past 2 years, but I think both of those are investable trends.
But the point I was trying to get to though is there has to be an effect on apartments out of this. Like you can't have two things happening at the same time, right? Where people are buying houses like crazy, like they're going out of style, and those people being disproportionately renters because those are the people who have the flexibility to do that, to move very quickly and have no impact on apartment occupancies. Like there just has to be an impact. And I don't think the impact is all from like this trend is also not all like everyone leaving New York or Los Angeles, right? It's happening throughout the country.
Oh, so, it's a country thing. Absolutely.
Yeah. So it's, you know, it's happening in Atlanta and, you know, Dallas and wherever it is, wherever people are in apartments and they are renting and they're able to move.
Yep.
They're moving to the suburbs around where they are and buying a house. So this is going to have an impact on multifamily occupancies without a doubt. And, you know, I think a lot of, look, for years and years and years, I've been hearing millennials don't want to own homes. And for years and years and years, I've thought this is the most ridiculous thing I've ever heard. Of course they want to own homes. They just haven't been really in a position to buy yet, or they've just been deferring this decision or what have you.
Yeah.
Well, and I knew at some point they were going to be just like everyone else and start buying homes.
It just broke.
So everyone who was saying apartments, because millennials, nobody wants to own a home. I've been saying,
just wait.
Don't believe the hype. Right.
Yeah.
So, and now this is the event that has caused that to accelerate.
Correct.
And the millennials who were in a position to buy are buying, you know, especially with interest rates having plummeted the way that they have, you know, and there's all kinds of, you know, first time buyer programs out there where you don't have to come up with 20%, you know, and
that's the hottest segment of the market. First time buyers. No question.
So I think this is going to have an impact on apartments and, you know, we'll see how that goes.
Yeah. Well, I just close on this and then we'll get into a fun topic is I've seen both New York and San Francisco, two big MSAs report significant rental rates drops. Yep. Vacancies in Manhattan. I'm sure you saw this stat were highest ever reported sometime this week. I think that was Tuesday. Things like 13,146 units, if memory serves, which is highest on record. Oh, by the way, in August, which usually is the best month for leases.
Right.
Yeah. Right. Cause you have the winter, you know, shutdown or whatever, or slowdown anyway. And then San Francisco is now giving away 2 months and had a 10% rent cut.
Wow.
You know, when you add that together, that's a big hit. So.
Yeah. Well, let's put New York in perspective though. I think it's at a record high vacancy rate, which is like 4.3%. So
true.
So it sounds like a lot, but just because New York is so big, 13,000 apartments is, you know, it's kind of a drop in the bucket. There are more than 1 million. I think there are like 1 million rent controlled apartments alone in New York City.
Oh, wow.
So 13,000 is not a huge number, but still, you know, it's significant thing that we have an all-time high vacancy number here since World War II. I mean, it's basically, I don't think vacancy has ever been higher than 3% in Manhattan since World War II. So 4.3, that's substantial.
And I think it's fair to say trending the wrong direction.
Right. And there's been a ton of construction also.
That's true.
In the last few
New
years.
inventory.
So,
yeah.
So,
well, let's get into a fun topic. I wanted to close on this one because this is fun. It's been a while since you've been in a deal.
Yes.
All right.
Yeah.
So you're looking at one.
And I'm actually in a deal right now.
I'm
in a deal right now. It's been quite a while since I was in one. I've been quite, as you know, wary of the market and been unable really to find deals that I like. But I'm in a deal now. I was actually invited into a deal by some sponsors that I know really, really well, and was very, very skeptical at first, just because of where we are. We're still kind of top of the market prices. Plus, we've got this COVID overhang. We don't know where it's going, and so my first reaction was really like, no way, no how. But as I started digging into the deal and raising objections and getting good answers to those objections, I realized that for a while now, people have been asking me, hey, Jonathan, if you had to invest in a deal right now, what would you invest in? And this is basically the deal that I would invest in. So it's a deal in Atlanta, outside of Atlanta. It's an institutional grade property. It's a very large deal, much bigger than the kind of deals I would normally be doing myself, which is actually something that's attractive to me, because when you're getting up to that level of institutional deal, there's a lot more kind of like cushion involved, right? There's a lot less downside risk than there is with like a small deal that's, probably older, has more deferred maintenance, maybe doesn't have quite the same level of tenant base, and appeal, doesn't have the same level of amenities. So all things considered, in looking at this deal, I felt like, whether given everything that's going on, we can hit the projected returns or not, that's putting that aside. If you think about downside risk, which I think you really have to be thinking about, this is makes me feel pretty comfortable when I think about the downside risk factors. So, one of the things I like about this deal is the location, which is in Marietta, Georgia. It's right outside of Atlanta, and it's been having, for the last number of years, that MSA has been having really strong population, inward migration, and this part of the MSA is very attractive within Atlanta, and the whole COVID thing has now accelerated these population trends, right? Yeah. So, all things being equal, if you've got a lot of inward migration, it's just going to help you keep the place occupied with tenants who are able to pay. So that gave me a lot of comfort in looking at this deal. Again, also the institutional level management, you're talking about really, really high level management company managing the asset, which you're not going to get in, much smaller assets. And then it's basically, sort of a B plus A minus level, wouldn't call it a luxury product, but it is a very, geared towards affluent renters who are much more likely to be able to work from home than your kind of C-class tenants who you might have in older properties, who are much more likely to get furloughed and be having to deal with the loss of supplemental unemployment. So all those factors together made me feel quite comfortable with this deal, especially thinking about it not from the are we going to make as much money as we want perspective, but thinking more about if you're looking for a place to put money that is going to be relatively resilient through this, this is the kind of deal where I think that's possible. So that's why I felt comfortable getting involved in it and bringing it to my investors. So
very cool.
It's exciting. I'm really happy. I mean, really happy to be involved in a deal again too. I mean, that's what I do. So it's tough being on the sidelines. So
It's
it's good to have
been
something to
3
sink my teeth
years,
in. Well,
2 years.
it's been, the last time I bought anything was actually 2015.
Oh, okay.
And yeah, so it's been quite a while, and sold everything last year, as you know. So it's
Right.
very, other than one deal in which I'm a very minor partner, I really have not been involved, been focusing on
That's
coaching
fine.
and,
Yeah.
waiting for the market to correct. So it's great to be involved in a deal again.
That's awesome. So in this deal, are you still in the, I guess, the due diligence and capital raise portion of the,
Yeah. So
the deal?
due diligence is ongoing right now, and we just started raising capital for it. So it is a 506C deal in terms of the capital raise, meaning that it is open to all accredited investors, but you must prove that you're accredited. So,
Got it.
so if people are interested in the deal, they can reach out to me. They can, participate if they are accredited, and they have to be able to demonstrate that they're accredited, either through a third-party verification or through a letter from their CPA, or the other acceptable methods of demonstrating that you're accredited.
And if somebody's watching this and is accredited and wanted to reach out to you, how do you like them to do that?
Yeah. So the best way to do that is to go to my website, which is twobridgesmanagement.com. So that's actually just Two Bridges spelled out, and management is MGMT. But
I will put that in the link.
up if you go, yeah. And if you Google Two Bridges Asset Management, you'll find us very easily. So just do that. There's an investor page on my on there, and you can just sign up right there, and you'll get into the system.
So anything else you can tell us about the deal, just to whet people's appetite? What's the projected hold period? Is it a value add? Is it what do you want to tell us about it?
Yeah, it's got a little bit of everything, right? I mean, it's a big deal. It's almost 500 units. It's an $80 million deal overall. The 5-year projected hold IRR is, actually, I think I'm not supposed to say those things. Yeah, I'm still unclear as to what I can say.
I don't think you can talk returns, but you can talk plans.
Yeah. The plan is that it's a 5-year hold. Yeah. The plan is to renovate units as needed. Okay. Which is a way of preserving cash too, which is another thing that makes me very comfortable with this deal, because it's not
a big burn.
It's not we're gonna go do a heavy lift and get out over our skis. This is a very interesting plan where, when new prospective tenants come in, they'll be offered the option of an existing unit with the existing package, or the beautifully upgraded unit for higher rent. Yep. And if they choose the higher one, then the renovations will get done. They can get done in about 10 days, and they can move into a brand new upgraded apartment at a higher rent. If they don't want to spend the extra money, they can do an existing one. Yep. And just move in. And so that means it allows us to control the pace at which the money is spent, and only spend money when the return is essentially guaranteed. So that is something that makes me quite
that's a good idea.
Also comfortable with the plan. Yeah. And the other thing too that made me comfortable about this deal is the break-even occupancy is like 72%.
Oh, there you go.
Which is you really have to sink very far to get to 72%. And this is when it comes back to the institutional quality and institutional management. Mm-hmm. It's very difficult to conceive of a situation. Now, not impossible. It could happen, especially if with COVID, if we really get into bad times, it could happen. But I think I feel comfortable with the idea that we wouldn't get down to 72% with professional, really high level professional management on site. And the other thing is that we're raising a very large reserve fund, so that actually we could go down to 50% occupancy for 8 months and still be able to make all the debt service and pay all the expenses of the property out of the reserve fund. So there's a lot of downside risk mitigation in this deal, which makes me feel.
That's awesome. I've never looked at a deal that big. I've never looked at a deal 1/10 that size. What is the raise on that? Is it like 35 million, 40 million?
It's about $26 million.
Oh, 26
altogether.
Okay.
Yeah. So,
cool.
But yeah, me too. This is like an opportunity to participate in a much bigger deal, with much bigger players and
yeah,
who are on a
gonna be
different level
fun.
of sophistication, where I can learn a lot from how they do their operations. And so it's
Oh,
a good opportunity for me.
that's awesome.
For
You're usually the big fish.
learning.
Now you get an opportunity to learn. That's pretty cool.
Yeah, it's very exciting to be able to be part of something like that. So
That's awesome.
Yeah,
I'm happy for you. Wow, Jonathan's in a deal. I always wondered when that would happen.
I know. Yeah, I know. Now, sometimes I was wondering if it was ever going to happen again, but yeah, here we go.
Well, very cool, man. Well, I appreciate you giving me some time on your Friday. Enjoy your weekend, and good luck with that house in the New York, upstate.
Yeah, absolutely. Thanks so much.
All right.